not just talking about these surging COVID cases, which are exploding around the country, and you entertain the idea of possible shutdowns in places, schools being impacted and the like, you know, the president not acknowledging the election result, the prospects of him not leaving office, however serious you think that is, or maybe not at all. The prospect of rising interest rates, you know, we're pushing on 1% or pretty close to that. Market doesn't seem to be worried about any of it.
Well, first, let me express my thanks to Jim and Degas for their service, and to all veterans the same on this very important day for our country. In response to your question, Scott, there will be one president on January 20th. I think the country knows that President-elect Biden will be that president. I think that markets are responding to that. The bond market is closed today. You mentioned 1%. I would suspect that if the bond market was open, we would see pricing above 1% for a 10-year Treasury. But I think what the market is thinking about for 2021, and what David Kostin has right here, is that there's three strong contributors to earnings and to the economy next year that wasn't present. Number one, you're going to get a CapEx recovery, which has been much needed. Number two, you are going to reintroduce globalization, and that is going to remove some of the strain that has been placed on consumers with tariffs on imports from China. And lastly, I still suspect that flows of capital will come out of the bond market and they will go into the equity market, both towards growth and towards value.
Well, that's where I want to go next, Jim, is this idea of value taking the mantle now as these growth stocks have sold off, albeit today is a nice rebound day. You've got the NASDAQ up by better than 200 points, and I look across my screen, which is what I'm doing right now. You've got all the mega caps up. You've got the stay-at-homes up, the Pelotons, the Zooms, the DocuSigns. All of those are having a nice rebound. The question is what happens now, right? We had some obvious moves on the vaccine news, but more, close to us now in the days ahead. What's going to happen with that trade? Does it revert back to how it was? Is there staying power for value? How do you see it?
I think there is room for both large cap tech and value to continue to perform well. There's no reason. Look, I look at the Apples, the Googles, the Facebooks of the world. You can't even say these are expensive, at around 30 times earnings in a low interest rate environment, not with the growth rates that they have in earnings. Look, the stay-at-home stocks, the Pelotons, the Zooms, and I'm going to throw in there the software stocks. I think these stocks that are trading at many, many multiples of sales are still too pricey. I've stayed away from them. That's the one area I don't like. But in value, look, you've already seen industrials rallying the last 2 months. I think financials are next. And we talked about this yesterday. I'm going to say it again. I think the three reasons are, one, you're going to get a steeper yield curve, and you already are. Number two, loan losses are going to be less than expected. Just listen to Jamie Dimon on the last conference call about that. And finally, you get into the first quarter, and the market is going to anticipate this now, that buybacks are eventually going to be allowed back by the Federal Reserve. So I think financials are the next sector to start rallying.
Yeah, maybe this is perhaps the next big battleground, right? Wells Fargo today says, we advise getting aggressive on the banks despite Monday's run-up. In banks, we have historic valuation, significant scope for upside potential, an uncrowded opportunity, and catalysts in the form of fundamentally driven reflation and near-term COVID solution, i.e. higher interest rates and the vaccine. Mike Mayo says vaccine progress should continue to help the banks. There's some upgrades today in that space. Is it something to believe in, do you think, finally?
Finally. I mean, some of these stocks are still down 30, 40, 50%, right? Year to date. So they haven't recovered. They are cheap. They're better capitalized, for sure. But you need a steep yield curve. And the only way you're really going to have a sustainable yield curve that steepens is if you have better growth and a little bit of inflation. And so maybe having a vaccine in the next, say, 2, 3, 4 quarters, that will lead to better growth. And then you will see the steepening yield curve. You will see a little bit of inflation. But I think you need those things for for financials really to outperform on a sustainable basis. I think you want to own special situations, which is what I do. I only own 4 names, and I feel really good about them. Most of them are turnaround stories, but I think you could pick your spots. Be patient, like Jim says.